Saturday, January 26, 2019, Monaco 64, home of alternative economics and contrarian views. Today I want to talk about how central banks are cornered rats and how their unprecedented policies of massive inflation of the last 11 years will end in tears. It will either be hyperinflationary collapse or a deflationary collapse. And in the end of the day, the monetary assets that will survive will only be physical gold and physical silver. Cryptocurrencies, yes, it's outside the system, but their track record is not as long as the precious metals. So I'll focus on the precious metals. I'll look at the fundamental and technical picture for the precious metals, for gold and silver, and also I will look into a book, and it's a very short book. It's less than 70 pages, entitled Fiat Money Inflation in France, How It Came, What It Brought, and How It Ended, by Andrew Dixon White. It was written in 1912. You can find free PDFs of this book, or you can buy it anywhere. It's quite readily available. And it's one of the reasons why, some of you might ask, how do you know they're cornered? How can you say that? Well, I've done a lot of reading about monetary history, what happened in the past, and how things work. Of course, I could be wrong, but in my opinion, looking at the past and seeing what happened in the past when monetary authorities or governments experimented with unconventional policies, we could see how things ended. And this is a great book to learn about that, and I will look into that after I look at the fundamental news that we've been seeing now in terms of what central banks are doing, and also what the precious metals are pointing to technically, and how the fundamental picture is looking even better as well for precious metals. So yeah, I'll have a look at this book and how it relates to today. First of all, let's have a quick look here at what happened yesterday. We had a big day for the precious metals, and more interestingly, precious metals outperformed the stock market and the currencies. And what do I mean by that? Well, let's have a look. The Dow was up 0.75%. S&P was up 0.85%, and the NASDAQ composite was up 1.29. Precious metals, though, gold was up 1.42%, so it beat all those indices, NASDAQ included, and silver was up 1.88%. So gold closed at 1304 late yesterday. I noticed how right when the Dow closed at 4 p.m. New York, gold was just under 1,300. But after that close, gold kept going up and broke through 1,300. This is the spot price. I saw headlines during the day that gold had soared over 1,300, but those reports were based on the futures. I look at the spot. So the spot only broke 1,300 at the end of the day. And gold outperformed the currencies, because even though the dollar was very weak yesterday, the euro rose 0.9%, so again underperforming gold and silver, and the pound rose just under 1%. So it was a positive day, in my opinion, and it showed strength for gold, even though in my local currency, gold is off the recent highs of around 1,029. I'm not concerned because in the end of the day, all fiat currencies are sinking. They just sink at different times. Now is the turn for the dollar to underperform a lot versus gold, but eventually they all sink versus gold and silver, versus the two money or two currencies, if you want to call them as well, that have withstood the test of time and have the best track record. So that's what happened. Good end to the week for the precious metals, I would say. I know the stock market is still quite strong, but the other thing I wanted to point out is that the Dow gold ratio is still looking good in terms of the precious metals. We bottomed around 17 towards the end, towards just before Christmas. That meant gold was doing very well, and now with the rebound in the stock market, that ratio had rebounded, but you can see that it's failing, and we closed just around 19 yesterday, and I think that trend's going to continue lower. That just means that hard assets, as represented by precious metals or tangible assets, are going to outperform paper assets, and I think what we've seen in the since Christmas is just a counter trend rally. So I wanted to show you that as well. Fundamentally, I mean, I saw this on Thursday, this story, and then I told myself these central banks, they're cornered. I mean, the ECB, for example, their rates are still negative. They've just stopped doing QE, and they've got nothing to show for that. Debt is still growing in the EU. Growth is anemic. You've got protests, populist governments everywhere. So what was the headline? Well, they had the ECB meeting and the press conference, and it says Euro tumbles after Draghi warns risks have moved to the downside. So you've had all these years of massive money printing. They're even buying corporate bonds, and they get no traction. And here's where I come to the fiat money inflation in France by Andrew Dixon White. And Andrew Dixon White, he was a PhD. He was late president and professor of history at Cornell University, sometime United States minister to Russia and ambassador to Germany. He was also author of A History of the Warfare of Science with Technology. So the other interesting thing about this book, I think I bought it around 2003, 2004. So I've been looking at this for a long time. And this was republished from a 1933, edition, reprinted from a 1933 edition. That was, reprinted by the president of the Bank of New York and Trust Company. And he even put a little, he sent this to all the bankers that worked for him in 1933, December 7th. And it makes sense because that was just about the time that FDR had confiscated gold and taken America off the gold standard domestically. So here's the letter he wrote to all his bank officers or employees, so that they would read this book, and I'll go through it. It says his name was J.C. Traffigen, J.C. Traffigen, President, Bank of New York Trust and Company, 40 Wall Street, New York, December 7th, 1933. Dear Sir, in 1790 the French people, by general acquiescence, embarked upon what they believed to be a harmless experiment in currency inflation. The results of this action are vividly described in Dr. Andrew D. White's book entitled Fiat Money Inflation in France, How It Came, What It Brought, and How It Ended. Will you do me the favor of reading the copy of this book sent to you herewith? If it impresses you, I shall appreciate your circulating it among your friends. If you have occasion to use additional copies, we shall be glad to furnish them as long as our limited supplies last. Very truly yours, J.C. Traffigen, President. So One of the interesting things they talk about in this book, and it's got to do with the ECB and the fact that they've inflated, they printed, their balance sheet is like 5 trillion, and they've got nothing to show for it. So he's like, he warns that risks have moved to the downside in his press conference. What this book shows is that the experiment in France, just before Napoleon came to power, just after the revolution, from 1790 to like 1796, was that they would start inflating the currency, printing the assignats. Things would improve a bit, and then they would get worse. The economy never got any traction. They had to keep printing, and eventually it all imploded and led to the rise of Napoleon. And sound money again. Napoleon brought gold back to the system after 1796. So that's what's that's one of the reasons why this experiment that we've had since 2008, with major central banks of the world printing trillions upon trillions, leaving rates near zero to negative, is the same thing, and it's to an even it's even bigger than what happened back in the 1790s, because this only happened in France. So France was only able to do this for like 6 years, but now the whole world is doing it. But nothing will change because, as Andrew Dixon White says here, it says at the back of the book from his introduction, legislatures are powerless to abrogate moral and economic laws as they are to abrogate physical laws. They cannot convert wrong into right, nor divorce effect from cause, either by parliamentary majorities or by unity of supporting public opinion. And why legislative? Well, because the central banks, even though nowadays they say they're independent, they're not, because all the QE they're doing is to buy government debt to keep things going. So don't be fooled. And it says the penalties of such legislative folly will always be exacted by inexorable time. The story, therefore, of the colossal folly of France in the closing part of the 18th century and its terrible fruits is full of instruction for all men who think upon the problems of our own time. So there you go. There's a lot more interesting stuff in this book. The fact that the French government at the time was cracking down. There's a reign of terror trying to stop people from using gold and silver. You could get arrested and executed for that. It sounds familiar. The police state growing since 2001 nowadays, not only in the US, but all over Europe and the UK. So what did Draghi actually say? That's the thing about central bankers now. They tweak little words, and it makes a huge difference. He said the risks surrounding the euro area growth outlook have moved to the downside. And in the previous press conference, a previous meeting in December, I think it was in December, he said the balance of risks is moving to the downside. So he changed a verb, and it's changed the whole picture. And at the end, he says, Draghi urges governments to raise long-term growth potential, which basically means he's telling governments to start spending more. So the legislative part, right? With the central, is the ECB really independent if they're telling, governments what to do? And the Zero Hedge article actually says, how would they do that? Why? By boosting deficit spending and sending their debt surging, which is great. If only Brussels didn't recently crucify Italy for trying to do just that. Well, what about the Fed? Yesterday, again, Zero Hedge reported a Wall Street Journal story saying that Fed is considering earlier end to quantitative tightening, QT. What is QT? Well, it's the opposite of quantitative easing. If you look here in 2008, around the same time as now, January 24th, the balance sheet of the Fed was around $860 billion. And then by January 2017, it was just under 4.5 trillion at 4.4. That's because they printed, they just created credit out of thin air to buy treasuries, US treasuries, and mortgage-backed securities. And then they started towards the end of 2017 to allow maturing securities in their balance sheets to roll off, which means they weren't buying them back again. By January 2019, we were at 4 trillion. So they've taken away about 400 billion. And they've been raising rates as well. Fed rate, the Fed funds rate were around, well, just over zero, 1/4 to 1/2%, up, from 2008 to the end of 2015, and they've raised it to around 2.5 now. And you've seen what's happened to the stock market and how the Fed is also completely backtracked in terms of raising rates this year. There's even talk that they might cut rates, and now there's talk that the Fed is considering not continuing the QT, that they might stop very soon. So it just again goes to show how it's impossible to get out of inflating once you start, and then when you try to drain the liquidity like the Fed tried in the last few years, things stop. The stock market starts imploding, so they have to pause draining, and then they'll probably start even printing again, because as you'll see in this book, if you read this book, once you start this, it's impossible to stop. The only way it'll stop will be a total collapse of the currency, and that's what I think we'll get, in my opinion. We are not any different from the French back in the 1790s. We haven't sussed out how we can beat the laws of economics, the natural laws of economics of supply and demand. Central banks are not omnipotent. They can't control everything. They can for a short time. So so this is what, in my opinion, fundamentally we're seeing here, a shift as central banks realize that they've got nothing to show for, and they're gonna have to probably start printing and cutting rates again. And probably that's why the Fed raised rates, because they knew they'd have to cut again. What about the technicals? This video is going on for a while, but it is the weekend. So I'll look at a couple of charts, well, a few charts. Let's start with silver. This is a chart we've been looking at lately. It's the weekly chart of silver. And I was talking about this falling wedge, how we broke out of it towards the end of last year, and how it just dropped back below that trend line. But as you can see, this week was a great week, and we're back above it. And it's looking good for silver. Where could we go? Well, I would say we could go towards 18 in the short term, short to medium term. Difficult to say. It could be in the next month or so for silver. Let's have a look as well at a daily chart of silver going back, to the beginning of 2016. And here I'll show you the moving averages, how that's looking very good to this daily chart, and how silver, the 50-day is moved above the 100-day. 50 days, the black line is moved above the red line, and it's fast approaching the 200-day. And you want that in a kind of a bull market. You want the shorter term moving averages to be above the longer term moving averages. And you can see how silver's held the 200-day moving average really well here this week. Gold, let's have a look at gold. Gold, I want to show you this this monthly chart, and it's going back to the beginning of this secular bull market. Yes, we've had the correction since 2011, and I did a Fibonacci retracement analysis with the low in 1999, which was the lowest level since, you know, the lowest level in the bear market we had in gold from 1980 to then, to the all-time high in in 2011, just above 1920. And I've been talking about the 1280 level because that's the 38.2% retracement of that huge move. It's 1283 there, as you can see. And yeah, this week we tested it. We went below it, but yeah, we finished up above 1300, and that's very positive in the long term. And you can see as well that the 50% retracement was at 1086, and that's pretty much where the low was. I know it was 1045, but it's pretty close, I would say. Now a daily chart of gold, just to show you the moving averages. I've seen some people talk recently about how the 50-day moving average has moved above the 200-day, as you can see there. They call it a golden cross, and that's very positive. And you can see technically as well, we were consolidating there prior to this week. We did see a big move lower, and it looked like gold was going to fail, but I guess that was a false, you know, that was a bear trap, so to speak. All the bears in gold thought, oh, we're going down now, and yesterday was very positive. So that's the technical picture there for gold. The Dow gold ratio I showed you already. I wanted to show you as well why the debt is so important. U.S. national debt, I look here at the debt clock. It's just below 22 trillion. It's 105% of GDP, and I think GDP is overestimated, so I would say that's even more. But I took this from American Bullion Inc., and it just goes to show between 2000 and 2015, gold and the U.S. debt had a monthly positive correlation of 93.7. And you can see how, you know, this is an old chart. It's not updated, but you can see how the debt has grown. We're at 22. Back then we were around 18 trillion. And gold at the time was just above 1200. So we haven't really moved that much in the gold price, but the debt has moved even more. That won't last forever, and that's why longer term gold needs to be a part of your, how can I say, monetary insurance, and that's physical gold and silver. You don't want to buy ETFs or futures. That's a banker's control mechanism. If you really want to hurt them, and if you want to protect yourself, it's got to be physical gold and silver. There you go. My conclusion for this week is technically the precious metals are looking very good. Of course, in the short term, prices go everywhere. My recommendation is always dollar cost averaging. Buy the physical whenever you can, if you have some spare fiat currency to exchange. Fundamentally, what happened with the ECB on Thursday at the press conference, and what Mario Draghi said, and all the stuff we're hearing about the Fed, and now the story about the fact they're considering stopping the quantitative tightening, is all pointing to more and more of the same, more fiat money inflation. And this time is for the whole world, and it all ends in tears. Either, you know, whether it's hyperinflationary or deflationary, it doesn't matter. Gold and silver will outshine everything, just like it did yesterday. If you enjoyed this video, make sure you hit that like button. Share the video far and wide with people you think would enjoy this kind of information. If you haven't subscribed to the channel yet, please do. And you can also follow me on Twitter, Steemit, and VTube. I wish you all a great weekend, and I'll talk to you later. Take care. Bye.